Welcome back, new YouTube video, and this is the video we all have been waiting for. This video is the third video of my 4-video YouTube course where I teach my strategy from A till Z. And the third video will be all about liquidity. And no, we're not going to talk about some simple sweeps here and there. No, I'm going to explain you what liquidity is, what participants are entering from that liquidity, and how we can use that to read traps in the market so we can trade into their liquidity. And honestly, before we start, I want to ask you, hit the subscribe button, hit the like button, to ask all of your questions in the comment section, and then we can start with this amazing video. Let's go. All right, now here we are. I have a few examples of liquidity straight on my chart, and I want to show you all the examples of what liquidity is, but more important, what participants are trading on that strategy. And we'll start with resistance and support, and it's pretty obvious that people are selling from resistance areas and people buying from support areas, right? That's easy. That's something we all understand. But what most people don't understand is that, okay, what if we take out that resistance area? What happens then? What type of trader enters when we break out of that resistance? Well, first we had sellers stuck in the market. Now we break out. Now we have breakout traders going long. So we have one type of trader. Now we have two types of traders. And now we also have break and retest traders entering on long. So we have already in this little area 3 types of different traders entering long and short, and this is what we call liquidity. And this is why we very often see that after this happened, price melts completely into its initial direction. And obviously this is also the other way around, right? So if we have a support area, price trades down into support, gives a little bullish reaction, inducing buyers in, SMC traders, I don't know, then the market sweeps. What happens? The support traders, the early buyers are out of the market, but now sellers entering the market on the breakout. Now we have break and retest traders that wait for the break and retest to also enter on short positions. So also here we have one, two, 3 traders entering purely off a support area. This is key information. This is something you have to understand, because this is showing you not only a sweep of liquidity, but literally it shows you different strategies that other participants are trading, and this is how you can counter trade. And I will show that in an example on the chart later on. Now, next thing we have is trendline liquidity. And to give you an easy perspective, trendline is nothing more than a support or a resistance in a trend line. And what's the key phrase? Every third touch of a trend line is where heaps and heaps of traders come into the market. So over here, meaning that this is where buyers are entering, especially if there's a demand area over here. This is a beautiful confirmation for traders to look for longs. Well, what we very often see is that price sweeps through the trend line. Then what happens? Breakout traders entering on shorts. Then we have break and retest traders. They wait for the retest on the trend line, and they entering short as well. Can you see that it's almost the same as it is for the support and resistance? Obviously, other way around. Normally, people enter on shorts over here, breaks out, people enter on longs, break and retest, people enter also on long. So we also here have 1, 2, 3 types of traders entering the market. Now, the very famous Fibonacci is also being used as liquidity. It's not my main thing, but it's a funny extra confirmation. The golden pocket is very famously used by Fibonacci traders. You can use it for equilibrium, for the 50% mark. Obviously, that's all fine. But if you trade from a golden pocket, you set yourself up for losing trades. And that has everything to do that if something is too easy, if something is too obvious, market makers, algorithms, they know it. And I will show you some in the other trade where you can clearly see that it's got taken out, and then price melts, for example. So Fibonacci could be a nice confirmation for a potential trade. Now, what if we put everything together? So we have a bullish range. Price comes down, price comes up, price comes down, creates a support area over here, creates a trend line over here. Remember, we have a sweep right over here. How many traders entering on sweeps? Well, obviously, loads of traders. So we have breakout traders, break and retest traders, not only from the support, but also from the trend line. So if we take this tiny bit of liquidity, now all those participants are out of the market, but there is a key element here. This is what I love to to say, a little bull trap. It's a little trap that plays out before the real move is happening. But did you notice that the moment we swept, we did an internal bearish break structure? And this is key because this will induce more sellers. Look what we have, trend line. Look what we have over here, potential resistance area. Look at the Fibonacci, comes in perfectly. This is already the confirmation for sellers to go short. They're waiting for the bearish break of structure. Now, this is where potentially SMC traders will enter. And it could also be here because sometimes they wait for an area of liquidity to be taken. And I will show you because I also have an example of SMC, but I don't want to be too conductive on that one because it can be hard to understand. This is where SMC traders go in. Everyone is looking for shorts after the sweep and after the bearish break of internal structure. And this is what I use to go against the market. And it's maybe it looks a little bit difficult, but it isn't. If you understand what other participants are doing, if you understand the true nature of price, this becomes pretty simple. So what would happen for a potential SMC trader, right? We have a range, it's bearish, internal structure, overall bullish. So it's not a real trade, right? It's not a real SMC entry. But remember that most SMC traders are not profitable. And this is the key phrase. So what happens? Price comes into a supply, comes down, comes up, breaks internal bearish market structure. What does everyone think? Retracement incoming. They think the market will retrace. They wait for price to come into the next supply zone. They wait for a 5-minute bearish break of structure. They look at the last 1-minute supply and what they they expect price from this area to melt down. Take this liquidity, for example, right? Most oftenly it don't happen, and it comes because there is what? Trend line above, resistance above. So there is liquidity above the supply zone, makes it a weak supply zone and a potential trap area. So now we have discussed different areas of liquidity, right? All written down over here. How would it look like if we take a trade? Well, let's look at this example. Markets overall bullish. A bit too bullish if you ask me, but hey, right? This is why I took that short over there. What do we have? We have an area of supply. Price comes in. From that area of supply, what do we see? Bearish price action. No, it's not a real break of structure, but it's internal structure stepping down. This is key, right? So we have an internal price action stepping down. We have an internal support area. We even have a little trend line over here that goes from this one to this one. Over here, boom, got swept, got taken out. Remember, all of those traders that were already completely wrecked on that sweep happens here as well. Now look at the details. If we go into the lower time frames, things will make more sense, right? What happens over here? We got down, slowly come up into what? A supply. Starting to push up, come down, into what? A support area over here. Now the details are pretty obvious because this is where the real trap is happening, and it's best to be shown on the 1-minute price action, I think, because now we can take the Fib tool. Look at that. Price retraces back into that area, gives that little reaction bearish, and then what happens? After all the liquidity has been taken out, price instantly moves up. Where to? Obviously into the resistance, into the trend line. Price is always hunting liquidity, and it goes from objective to objective. This is key. So honestly, if you want to learn how to read this price action, well, easy, join my Discord. I help you over there. I teach over there, and it's free. I have a free site, and honestly, it's priceless. You should be there. I make sure the link is in the description. But if you understand liquidity to a T, if you understand how this stuff really works, trading will become a hell of a lot easier. All right, don't forget to subscribe, like this video, and if you got any questions, like I said before, put them in the comment section, and I will see you on to my next video, which will be the last one of this 4-video course. Thanks for watching, and cheers.